In this video, I'm going to talk about 10 things that can ruin financial success in retirement. I was going to separate these things out into things that you can avoid and things that aren't avoidable, but then I realized that everything in here that I'm going to tell you about, all these 10 things, can be either avoided altogether or they can be managed. They can be managed in a way that minimizes the risk that comes with these things happening or affecting your financial success in retirement. So let's get started. Okay, the very first thing that can really change your financial success is changes in tax rates or things related to taxes. So that might be changes in rates, okay, changes in rules around taxes, as well as audits. If you happen to get audited and you find out that you owe a lot more money than you thought that you did. So tax changes are something that can really, really have a huge impact because it is such a huge expense for most people. So that's the first thing. And you can mitigate this by simply doing a great job with your taxes and making sure that you have separate accounts set aside if you're expecting that you're going to owe extra money or more money in taxes than you had anticipated. Okay, the next thing that can really ruin your financial success in retirement is divorce. Believe it or not, a lot of people end up getting divorced as they head into retirement simply because it's sort of timing with the final stage of raising children and or empty nesters, and divorce happens. People stop their work and they realize, well, gosh, is this all there is? Am I still happy with this person? And a lot of people realize that they're not. The problem with divorce financially is that expenses double. I mean, you have to pay for 2 homes, you have to pay for 2 everything just about. So it can really, really wipe out anyone that's in retirement that goes through this. So what can we learn from this? Just to take care of our relationships and make sure that this doesn't happen. The next thing that can really destroy your financial success in retirement is inflation. We've seen this lately. We were so spoiled with that nice little 2% inflation, or reportedly 2%. I won't go down that rabbit hole, but lately, inflation has been much, much higher. We're all seeing it. We're all experiencing it. And we are seeing how much it can hurt our finances and our ability to maintain our standard of living. So it's something that's super important to plan for and to have investments that will serve us well during times of higher inflation. The next thing that can totally ruin your financial success in retirement is related to liability issues. Things happen, and unfortunately in the United States in particular, there are just so many frivolous lawsuits that really are without warrant, without merit. And this is something that fortunately you can protect yourself against in almost every situation, and that's by having good insurance. And I suggest that, or I personally I don't really give financial advice as a financial coach, but I like having umbrella insurance, and I think it's really nice to have if you have, if you're in a situation where you might need umbrella insurance. And for the amount that you have to pay for it, it's very, very reasonable. And of course, there are other forms of insurance that you'll want to make sure you have in place to protect yourself from liability. The next big thing that can ruin your financial success in retirement is investment returns. When investment returns aren't what we thought they would be. I hope you've seen my video on the formula to estimate how much you need to retire. You'll know from that video that investment returns are super, super important in determining how much you need to retire. This has been forgotten by most people now, but in the first decade of the 2000s, the S&P 500 actually had a negative average annualized return of almost 1%, and that was when we included dividends. If we took dividends out, it was almost 3% average annualized return for the entire decade. So that wasn't every single year was that amount. If we averaged the annualized return of the S&P 500, it was almost negative 3%. So that wiped out retirement plans. And a lot of people say, well, the boomers messed up and da da da. Well, this really, really obviously hurt a lot of people that were headed into retirement just before the 2000s decade or at some point during the 2000s decade, because most people rely on stocks for the growth part of their portfolio. And yes, most investors did own bonds, but bonds as a way to protect portfolios from stock declines, just they don't deliver the same kind of returns that stocks do. Stocks are associated with growth, and they had been really, really a fabulous growth investment vehicle in the 1990s. So people were used to that, much like now. So investment returns can totally destroy your financial success in retirement, and that's why it's so important to make sure you understand your investments and understand how your returns will be under various economic situations, under various scenarios. Yes, we had a great financial crisis, but we've also had times when interest rates were over 20%. We've had 13% inflation. We've had horrible, horrible real estate cycles. We've had horrible bear markets, much, much worse than we've had in the 2000s decade. So it's important to understand that the way you're investing, whether or not it will work in different economic situations and those different macroeconomic factors. The next thing that can really, really derail your financial success in retirement is making mistakes on your retirement planning estimates. A lot of people estimate either too conservatively or not conservatively enough. It's the not conservatively enough that's the problem when it comes to wiping out your success, your financial success in retirement. And that takes the form of overestimating how much your investment returns will be, and I've already gone down that rabbit hole in my last point. And it can also take the form of underestimating how long you're going to live. Good, bad problem to have. And it can also take the form of underestimating inflation, or the impact that inflation will have on your financial situation, on your ability to maintain your standard of living. So making mistakes in your retirement planning estimates can really, really blow your retirement. The other really big one is estimating to make retirement withdrawals of the wrong amount. 4% is the standard. It's the commonly recommended amount, but I can promise you, having invested for 40 years and having been an investor through bull and bear markets and paying attention to all this for so long, because as you can probably see, this is my passion and my interest. After the 2000s decade, when so many people had lost so much money and we were just going into a fabulous bull market, all the financial experts were recommending, oh, you need to cut back and your retirement withdrawals and lower them to 2 or 3%. Now that things have gotten really risky again and assets are overvalued, then now all of a sudden it's 4 or 5% is how much you can plan on to withdraw in retirement. So understand this, and understand that this is a really, really crucial amount. So do some research, find out what you're comfortable with, and it really, really ties back to your investment returns. It really ties back to your investment returns, because you need those investment returns to fund those withdrawals in an ideal scenario. Okay. And the next thing that can end up ruining your financial success in retirement is an unexpected ending of an income source. This could possibly be something such as Social Security. I'm not going down that rabbit hole. It's just way too deep for me. But you're an unexpected source of income. Maybe it's something else that you're doing that you're expecting will always happen, like an insurance payout, and something happens to the insurance company, or something completely unexpected. So look at your income sources that you have in retirement and say, what is the probability that this could cease? And how would I handle that if it does cease? Now, there are a couple of other things that I think are possibilities, but I think they're things that we also can control a little bit more, so I want to throw them out quickly, and that is a change in the rate of financing. I know many of you comment that you don't have any debt, and a lot of people are super excited about completely eliminating debt, which is kind of weird because we've just had such a great time to finance things because interest rates were so incredibly low, under 3%. And there was a time when I paid about 10%. But having said that, most of you, many of you who are my viewers, don't have any debt at all. But I know in countries outside of the United States, it's common. You can't lock in interest rates. It's common to not be able to do that. So if you have something that's financed and it's at 3, 4, 5% and it suddenly rises to 6, 7, 8%, wow, that can really, really wipe out your financial success in retirement. So check your financing, make sure that if you do have any, that the rate is locked in, it's secure, it's something that you can handle. The next thing might be an unforeseen family issue that you really need to help out a family member. So look at that and have family conversations about money. And it's weird how people avoid it. It's such a popular, should be common topic. It's not a common topic, but it's a common thing that we all deal with. And I was really fortunate this was a common conversation in my family, and I don't get why more people don't talk about it more. In fact, I think I'm so comfortable talking about it that it can make other people uncomfortable, and hence here I am with my YouTube channel because I can talk about it. Okay, and then there's one more thing I want to mention, and that is health. Because, well, bad health can totally ruin, lifestyle as well as your financial situation if you need help that you hadn't planned on, you hadn't budgeted for, and you just, didn't plan on the expenses. So those are things that can be problems as well. And remember, with all this, remember to retire certain.